Hello, Chair Gensler.
Hello, Amy.
Okay. Now it is my great pleasure and honor to welcome Gary Gensler, the chair of the Securities and Exchange Commission, back to CII. In Gary Gensler's nearly 2 years in office, he has led a sweeping regulatory revamp that spans corporate disclosure, equity market structure, and special purpose acquisition companies, to name just a few. And under his leadership, the Commission plans to finalize 24 proposed rules this year, according to your most recent rulemaking agenda. I know that CII and many members are heartened and grateful that so many of the reforms you are leading align very much with CII priorities in corporate governance. And I'll just tick off 3, finalizing rules requiring listed companies to adopt clawback policies, requiring universal proxies, and for closing loopholes in executive trading plans and company stock. So thank you for that. Gary Gensler began his career at Goldman Sachs, where he was one of the firm's youngest partners. His career since Goldman has been in public service and teaching. He was a senior advisor to Senator Paul Sarbanes in writing the Sarbanes-Oxley Act. He served in key positions in the Treasury Department and chaired the Commodity Futures Trading Commission. A native of Baltimore, Gary Gensler also chaired the Maryland Financial Consumer Protection Commission. Prior to joining the SEC, Gary Gensler taught at MIT Sloan School of Management, and while there he led initiatives on digital currency and advanced data analytics. Welcome. And let's just jump right in with, I guess, the topic du jour, which is the climate disclosure rule that's pending. Many proponents and critics of the SEC's proposal have described some aspects as controversial and ambitious. And it's widely expected that any final rule will be litigated in the courts. So to start, please explain the importance of climate-related disclosures to investors and to the U.S. capital markets.
Thank you, Amy. Thank you for your input, the CII's input on each of these proposals. We really benefit from public input and the council and its members' input. In terms of climate risk, investors have for a number of years been making investment decisions in part related to climate risk of the registrants. Companies raising money have responded by putting out information to those investors. They're putting out information on how they manage that risk, but they're also putting out information with regard to their greenhouse gas emissions and the like. All of that information is now in the capital markets. And what our role is about bringing some consistency and comparability to that disclosure. And so that's what we put out a proposal on last year. And so ours is an important role, but it's a narrow role. It's about full, fair, and truthful disclosure.
Thank you. But the SEC is being sued or likely to be sued over that rule and over other rules. How do you factor court challenges or the likelihood of a court challenge into either the final rule over climate disclosure or your rulemaking in general? What do you want?
It's really straightforward. The best thing is to stay within the law. And so I know that your audience is going, yeah, that sounds straightforward. But we've got the securities laws and staying within those authorities and how the courts have interpreted those authorities. And part of that is also the Administrative Procedures Act and staying within that, the how we do notice and comment rulemaking, and really importantly, how Congress has laid out that we look in every rule we do at the economics, and that it means technically looking at efficiency, competition, and capital formation. So we benefit from the input. We get input on economics, we get input on legal authority, we get input, of course, on policy, and then staff considers it, makes recommendations up to the 5-member commission. But it's really staying within the law and how the courts interpret the law.
So you can see a path to surviving a court challenge?
Well, that's of course, we haven't yet finalized the rule, but we've gotten nearly 15,000 comments in the climate risk disclosure rule. more than we've gotten on any other rule, I think, in the history of our commission. About a third of those are unique comments, weighing in on different aspects of the rule, whether it's weighing in on from the investor side or the issuer side. And it's just sorting through those and seeing how we move forward.
Are there any lessons learned from your experience with the climate disclosure rule and the pushback on it that will help inform the SEC's future rulemaking on human capital management and board diversity?
Look, I think that the issuer disclosure proposals, and we also did something with regard to cyber risk disclosure, have some consistency about that. We have a long history, nearly 9 decades of writing rules around disclosure. So this is something that's very much within our main, one might even say the first law that was passed, the Securities law, the Securities Act of 1933. Our main sort of remit is about issuers raising money from the public and those disclosures, whether it was adding management discussion and analysis or risk factors or various environmental disclosures in the 1960s to 1980s, adding other things about corporate executives along the way. And I think that it's really hearing from both investors on the one side and issuers on the other, and then trying to bring some consistency and comparability. And as you said earlier, anticipating, as you said, that there may be challenges on any one of our rulemaking is just staying to our knitting. Core to that is we're merit neutral. Congress decided that many, many decades ago. We're merit neutral, whether somebody wants to go long a risk or short a risk. In this case, whether they want to go long green or short green. We're merit neutral. It's just about bringing consistency and comparability to the material information that investors consider when they're making investment decisions.
Okay, thank you. Last December, the SEC issued for comment 4 rulemaking proposals related to equity market structure, 1,600 plus pages. Many of those provisions seem to relate primarily to retail investors, individual investors. I think many in this audience and our staff are wondering what's in it for institutional investors. Could you perhaps point to 1 or 2 provisions in these proposals that should draw our attention and that would provide significant benefits for institutional investors first? And second, how can we be helpful in comment letters? What are you looking to hear from institutional investors on those provisions?
Well, I think that each of the 4 proposals address separate aspects of the markets, but let me just name a couple in terms of the institutional side, as you said. Best execution. We made a proposal on best execution that a broker-dealer would have obligations and responsibilities to your members, the institutional investors as well as individual investors. And it cuts across not just equity markets, but equity markets, fixed income markets, yes, even crypto markets, and cuts across all of those. To date, we at the SEC have not had said rule. It's been a FINRA rule, self-regulatory organization. I think moving it up to the SEC is really important. We put it out to public comment, but it does touch upon institutional investors. Let me just mention another piece is just we put out a proposal that a certain sector of individual orders less than $200,000 in size, some people would call them marketable retail orders, but a certain sector of orders be put out to greater competition. That would avail institutional investors competing for the suite orders because small individual orders tend not to have what's called adverse selection. And so why not open that up more competition, more efficiency in the market, but institutional investors would also have an opportunity to get part of that order flow. And then lastly, I would say institutional investors weigh in and give us your advice and feedback on the rules we proposed with regard to minimum increments, trading increments, and quoting increments, and trying to level the playing field between the lit markets and the dark markets.
Okay, thank you. So the core of CII's membership are pension funds, and many pension funds are investing more of their assets in private equity and private markets generally. Should the SEC seek to close the gap between public company and private company disclosure? And should that closing the gap involve perhaps include both increasing private company disclosure and decreasing required disclosures for public companies?
So let me address what we do have out, we put out last year for comment. You're right, private capital markets exist aside public capital markets. And part of that are the companies themselves, and part of that are the funds themselves. These funds in aggregate are larger than our entire commercial banking system in the US. Between those that report on our what's called Form PF and some exempt reporting advisors combined, it's $25 or $26 trillion of assets under management. Pretty significant to our economy, but really significant to those pension funds and the people behind those pension funds. Just working and retired Americans on the other side of those pension funds. So instilling greater transparency and competition in that marketplace, the marketplace for asset management this is what we did in the proposals last year. Secondly, you're asking about the companies themselves, and maybe it's because I grew up, my dad had a small business. It never tapped the capital markets, but it was a small business of 30 employees or so. I think we have vibrant both public markets and private markets, but when they get to a certain size as prescribed by Congress, when they get to a certain size in terms of the numbers of shareholders and the like, then the public benefits from that disclosure that we talked about earlier.
Well, there's different ways to measure size. Are you thinking about changing that?
Congress has chosen to measure it by the number of shareholders, but you're absolutely right. There are appropriately different ways to measure size.
Okay. I have one more question, then we've got a lot of questions lined up. You've been criticized by some for regulating the crypto industry by enforcement policy rather than by proposing rules. Why have you to date been reluctant to propose new rules to govern crypto?
It's pretty straightforward. There already are rules. They're called the securities laws and the securities rules. There's nothing incompatible about crypto and the current securities laws. So I think that really the goal of this agency is to bring this field into compliance. And why do we have that goal? It's so investors get the time-tested protections of our securities laws. And so those companies out there, if they choose to try to avoid the law and they're still operating in the US, they're offering products, they're offering broker-dealers or exchange or clearing products or staking as a service or lending products here in the US, come into compliance, or yes, we're going to be a cop on the beat.
Okay. Why don't we go to we've got tons of questions lined up for you from the audience. Do you worry that the pace of rulemaking has been so quick that market participants haven't had time to provide all of the feedback they have?
We get significant feedback from market participants, and we benefit from that feedback. We went back and looked a little bit. My immediate predecessor, I think, moved 64 final rules during his 4 years. So I think that we're moving apace. We put things out to comment. We get the feedback. We take the meetings, keep engaging with the SEC. We benefit from that robust public engagement.
Okay, thank you. Here's one. What are your thoughts on Senator Warren's letter about finalizing the climate disclosure rule?
Again, we benefit from robust public engagement, particularly when members of the Senate and the House weigh in, and we get feedback from from them, and we incorporate all of that feedback and respond to that feedback as the law suggests we should in the final rulemakings. In terms of the specifics of the climate rule, I think that we talked about this earlier, 15,000 public comments. And the reason the public's so engaged in this is because investors currently are making investment decisions based upon the climate risk disclosures companies are making. So though we're merit neutral, and there are people around these debates that want to push or one agenda or another, our only remit is about full, fair, and truthful disclosure and trying to bring some consistency to the disclosures that are already in the mix.
Okay. This is jumping around on me. I have an app in front of me. Okay. Let's see. The U.S. intends.
Slido
yeah, it's Slido, and it keeps changing. It's sliding around on me. Let's put it that way. Do you think that market participants would benefit from standardized human capital and diversity disclosures? And what's your appetite for introducing this soon?
Look, I'm just going to go back to maybe my early days as a professional at Goldman Sachs. I just recall anytime we put together a prospectus. Now, I was working the merger and acquisition area. I was helping people sell their companies. There would be some details about human capital. And this is like 3-4 decades ago. We would put together key features about the workforce, about the turnover, about the benefits, and the like. And building upon that which the commission did just 3 years ago on this area about disclosing relevant information, material information to the public so they can make investment choices based upon understanding some of that relevant information about human capital. It's already in the mix. It's just looking at the disclosures from 2021 and 2022 and how issuers have taken on that final rule about 3 years ago.
Here's one that a lot of people want you to address. How concerned should investors be about the anti-ESG wave?
I'm not sure I fully appreciate why so many people have lined in. I mean, it's just really, as investors, as institutional investors, we've heard significantly from you, at least as it relates to this climate risk disclosure, that you're already making decisions based upon the disclosures by the issuers. And so we're trying to sort of look to how to bring some consistency to that and help you, investors, make your investment choices so you can compare and contrast different issuers.
Thank you. The U.S. intends to move to T+1. In the meantime, investors are still waiting for ownership, the proxy plumbing issues to be addressed. What's the problem?
Well, I thank you for highlighting that we're moving to T+1. Amy, do you want to expand a little bit on the question about?
I wish I could. It came in, but there's. I think that the proxy plumbing issues are a kind of a perennial. They're always on the back burner at the SEC. It seems, at least over the last decade or more. Periodically, the SEC has roundtables, or these issues come up, and they just seem to come up, and these issues would come up and recede. I'm not sure what that has to do with T+1, but.
Look, I think that we've done a lot with regard to proxy voting. We have a proposal out actually around that area. Some might know this technically is called 14A8, but when companies, issuers, take up votes and so forth, we've done, as you were kind to thank us earlier about universal proxy and the like. But you're right, there is the backbone, the infrastructure of how votes move through the system, how beneficial ownership is handled. Many individual investors also are looking at direct registration systems and how we ensure to facilitate that. Many institutional investors are also looking at how they vote. And so it has been things that the staff continues to hear from both individual investors and institutional investors and some companies about, but we don't currently, as you say, don't have that on our regulatory agenda.
Right. I'm just going to look, I can't really see, I think there's an ability to ask questions using a handheld mic, but it's hard for me to see. So does anybody have a question they want to ask in real time, in real life?
So you're saying those Slido questions weren't real life?
Okay, well, we have some more, and I have one since we're on 1488. Last year, the SEC modified the shareholder proposal rules, and partly as a result, a record number of proposals came to votes on company proxy cards last year, and many more proposals particularly with environmental and social issues came to votes. Average support for those proposals on environmental and social issues, however, declined compared to 2021. Just wondered what impact, if any, do proxy voting trends have on the SEC's priorities, and how does what does the staff plan to do going forward on this front, if anything?
Again, we as an agency are merit neutral, but what we not is like neutral to that investors own their companies, whether they be large institutional investors or individual investors owning 10 and 20 shares. They own their companies, and shareholder democracy has been part of our remit, again, for about 88, 89 years. And over the years, we've facilitated that. What we did last year is, in essence, sort of just go back to somewhere. The staff went back to where we were, I guess, 4 or 5 years ago in terms of those proxy proposals. And we also proposed something at a commission level that's still out to public comment. We haven't finalized it, or I should say it's the comment period closed, but we haven't finalized it on that. And any input or meetings, of course, will be reflected in anything if we do finalize that.
Okay, thank you. There's a couple more rules, questions that I think relate to the climate disclosure rule. How will this rule align to or differ from the IFRS as to standard the two standards that coming out of this IFRS later this year, the ISSB standards?
Yeah, so I think you're talking about the international standards, International Sustainability Standards Board. And it's, I think, just been recently finalized. We, of course, you earlier asked about the law and the courts and everything. We live within our legal authorities, within our capital markets, and we'll consider whatever potential final rules within that. The International Sustainability Standards Board is, of course, just a set of suggested standards for nearly 200 different jurisdictions to work from. We both built upon, though, the same common framework that literally thousands and thousands of issuers already are looking to, something called the Task Force, or TCFD that you might know, the Task Force for Climate Risk Disclosures. And we happened coincidentally to propose our rule about the same time that ISSB proposed theirs. So the public sort of engaged in both processes in a similar time frame with many similar comments. Investors significantly supportive. Issuers, of course, the public comment files you can look at, raising some issues about the challenges they might face in those disclosures. And while we appreciate and look at what ISSB is doing, really we have to stick to our comment file and the comments that we've received.
Okay, thank you. Let's see. Can you comment on any appetite to mandate greater disclosures on income tax paid on a country-by-country basis? calls have been growing for the SEC to mandate this.
I'm encouraged by, and I'm speaking, I should have said this earlier, I'm not speaking on behalf of the Commission or the staff of the SEC, standard disclosure, but I'm encouraged that the Financial Accounting Standards Board has taken up disaggregation projects, and that, in essence, one of their disaggregation projects is disaggregating income tax around major jurisdictions. I think that investors benefit to better understanding those jurisdictional issues with regard to tax management at companies, and particularly as various jurisdictions consider, potentially global minimum taxes. And I think that while it's a step removed from the SEC, that work at the Financial Accounting Standards Board, I just want to say I'm encouraged by that, and I think investors benefit by that disaggregation of major jurisdictional tax components.
Thank you. Here's a question on one of our pet issues, dual class stock or the problems with it. What power, if any, does the SEC have to address multi-class equity structures and differential voting?
You know, if I was at a congressional hearing, I'd say I look forward to having my staff learning more of your issues there. So much of that is steeped in decades of state law and state jurisprudence and the like. And when I started on Wall Street, of course, I think the stock exchanges didn't allow dual class listings, and then they did, and they changed things. But I don't have anything for you today on that, Amy.
Okay. I'm not surprised by that. We thought we'd try. The SEC's proposal for private funds includes proposals with broad support, such as fee transparency, while other items have mixed support. Will the SEC do the easier items first?
Well, again, I don't want to get ahead of staff and their recommendations or the consensus that forms around these issues at a 5-member commission. My resting foot was, look at the size of this field, $6 trillion in assets under management. Depending upon what you think the average general partner revenues are, you can start to measure up, we're talking about hundreds and hundreds of billions of dollars annually of fees. And so greater disclosure about those fees, greater disclosure about the performance, greater disclosure about the side letters. We've heard significant comments, support in the comment file from from pension funds, endowments, state treasurers, and the like, that they feel that they can benefit from that greater transparency and, in essence, helping the competition amongst asset managers for this literally growing and, one might say, burgeoning asset class of $20 to $30 trillion of assets.
Okay, thank you. There's a lot on climate still. Is there a case for just moving ahead with Scope 1 and Scope 2 emissions disclosure, given the difficulties in estimating Scope 3?
Again, I don't want to get ahead of the process, but as we said in our proposing release, that there's several things. There are far more companies that are already disclosing Scope 1 and 2. Far more investors are looking at that, making investment decisions. But Scope 3 emissions are disclosed by some investors, many disclosed by some issuers. Many investors are looking at this information as well. It's not as well developed. That's why in our proposal, we took a tiered approach, a different approach to Scope 1 and 2 than we did to Scope 3. Again, I don't want to get ahead of staff recommendations, but I think even when we made the proposal, we took different approaches to the different levels of disclosure.
All right, well, I know we're counting down, and you can't stay with us past our window of time. So I want to thank Gary Gensler, Chair Gensler, for being with us today, for answering so many questions. Thank you.
Thank you, Amy. It's always good to be with you and your members, and I think this is probably the third or fourth time that we've done something like this together, so thank you.
Thank you for being here again. We appreciate it.